Hi guys, good morning and welcome to Trading Hour. I'm Pavitra and we are going to be joined by Rima also in just a bit. First up, a quick look at the markets. Once again, we have ourselves a very flat day, attempting a move higher right now, but it's just around 18 points higher on the Nifty. So really not too much in terms of what you're seeing on the index level. What is the good news is that the mid caps and small caps are really holding up well. So the mid cap index is up 0.6%. You're seeing the small cap index do very well as well. In fact, if we can get the weekly move up for these indices, you'll see that the small caps are up almost 3%. This is for the week. The mid-cap index is up 1.5%. Nifty, overall has also had quite a decent week, 1.6% higher there. Let's take a look at some of the sectoral indices because you're seeing that play out once more. What is clearly the best this week is the PSU Bank Index, up 6% over there. The Nifty Realty Pack is up almost 5%. And IT also, after that, badgering we saw last week on the back of Infosys' results, it was down 5% for the week. This week, it's come back around 2.7% higher right now. Once again, today, you have a lot of the tech names which are holding up well. Some of the larger ones, of course, but these are the mid-cap ones which are holding up well. One pocket which has really continued to shine this week is in all of those railway related stocks. So you have these moves up. This is, for the week. But if you take a look at the month kind of performance for these, you have RVNL, which is up more than 60%, 63% on RVNL. IRCON is up 40%. You have something like a RailTel also, which is up 20%. So there are definitely pockets within this market that are really doing well as well. And on an index level, like I was pointing out, it's quite flat right now, but you have the broader market supporting, which is why the advanced decline is in solid favor of the advances right now. We have almost 2,000 stocks which are advancing for 800 which are in the red. So that is the shape of the market. We will come back to this, but first up, let's get you a corporate conversation going because we are in the midst of the earnings season. So I'm going to invite the management of Dwarkesh Sugar on the show now. They reported healthy revenue growth, but what came under pressure this time was the margin, specifically in the distillery segment. So to discuss the Q4 earnings and how the current year is panning out, we are joined by the management. MD Vijay Banka joins us now. Mr. Banka, thanks a lot for joining us. This is Pavitra. So, like I was pointing out, the sore point this time seems to be the margins, particularly in the distillery business. Can you tell us what happened on that front and what is the outlook here? Do you expect that this segment will remain under pressure for a while?
Very good morning, Pavitra. Well, yes, I must confess that, yes, this quarter has been rather muted in terms of performance. And more particularly, as you pointed out, the distillery segment. Yes, distillery segment, you see, there are 2-3 things that have happened. Number one, the recovery was rather low. The sucrose content in the sugar that we crushed was rather low, so it directly impacts the recoveries in the ethanol segment also. And number two, we produced the entire ethanol that we produced and sold was by using sugarcane juice directly. And the pricing of the ethanol from sugarcane juice is little on the lower side. And as compared to the pricing of ethanol that we make from B-heavy molasses. These are a couple of reasons why the segment margins have been little under pressure.
What's the outlook, sir, on the distillery segment margins going ahead?
Once again, the sugar prices are on the rebound now. They were very subdued in the entire last year and more particularly the last quarter. And secondly, we are making efforts to, recalibrate our varietal mix, have more variety where the sucrose content is higher. Because the one variety that we have been excessively depending upon, 0238, has been under the pest attack of red rot, which has created all kind of chaos in the sugarcane growth. So the dependence on that particular variety is being decreased. So we expect, and the model that we're going to follow is that we will be making ethanol from juice directly the season. And during off-season, we'll be using B-heavy molasses, which has already been generated and stored. So we're going to use that. So we will be able to, next fiscal, we'll be able to sell 11 crore liters of ethanol at least. So we expect both the top line as well as the bottom line of this segment should see some healthy growth.
Okay. Mr. Banka, you were just mentioning the sugar prices also, right, which are rebounding now pretty much at an all-time high. Can you tell us what the realizations have looked like? And I can understand that, maybe Q4 will look a little bit warped because of what's going on with the prices. So what is the average realization for all of FY23?
So the entire FY23, the realization has been around 3,450 or so. You see in in FY23, most of the sugar stock that we sold was what was produced from what was produced in FY season 21-22 and 22-23, where the sugar cane price was higher. But you're right, the sugar prices have seen some kind of revival. Prices which are hovering around 3,400 to 3,450 are now at around 3,600 levels. And as you know, the international prices are at an all-time high, but they have not found any resonance in the domestic prices. But going forward, yes, the sugar balance sheet within the country looks good in the sense that we expect to close the inventory levels at 6 million tons or so. So we assume we do expect that the sugar prices will remain at around 3,600 or 3,700 rupees going forward. And there is already fear of El Nino impacting the second half of 2023. So, we need to watch all the developments, but we are optimistic that sugar prices should do good in the coming year.
What about exports? What are the export realizations? What are international sugar prices looking like currently? And what's the volume of exports that you're targeting?
International prices are at an all-time high. They have crossed 26 cents mark. And if you translate that international sugar price into domestic prices, then definitely it's over and above 4,000 rupees a quintal. But anyways, that hardly matters in the Indian context because the exports are controlled by the government. For the season 2022-23, governments announced a quota of 6 million tons. Government watches the stock situation, so we really don't know at this point in time how much export quota is going to be allowed in the coming year. But India is fundamentally a sugar surplus nation, surplus sugar producing nation. So I'm sure more export is going to be allowed for the season 2022-23-24 as well. So it depends what policy the government frames, because in 2022-23, the government allowed sugar mills to swap their export quota with the domestic quotas. And many mills in Uttar Pradesh, because we are in the hinterland and the transportation costs are higher, we swapped our quota with the export quota with the domestic quota with mills in Maharashtra. So the benefit of higher export domestic quota we should get in the coming 6 months.
Okay, got that. There was also talk of ISMA cutting down the production targets, right? Can you tell us what this could do to your margins, to your volumes? Do you expect that your volumes will come down for the coming year?
See, ISMA has come out with a number of 32.8 million tons of production for season 22-23. Most of the mills in Maharashtra and Karnataka have already concluded their crushing operations. So sugar mills in UP are still working. There again, some mills have already concluded their crushing operations. So 32.8 million tons indicates that we should end up with a closing inventory of around 6 to 6.5 million tons, which translates to approximately 3 months consumption. So this is a healthy balance sheet, where the sugar prices should be good, and at the same time, I don't think it will be that. It will be so much elevated that there could be inflationary pressures on the inflationary pressures.
Thank you very much for joining in. We need to slip into a very short break. On the other side, we'll discuss what's buzzing in the commodity space. Manisha Gupta joins in next. Welcome back. We'll continue our discussion on sugar now. Manisha is now joining in, focusing again on sugar. Manisha, did you have a chance to listen in to what Dwarikesh Sugar had to tell us? Sugar prices are high in domestic and international markets.
Oh, well, absolutely. And I'll just add to that. And I really wish I could join in when Dwarikesh was talking. But yes, you know, this year started with 19.7 cents a pound for sugar. And we are trading at around 27 cents a pound right now. So the kind of run-up that we have seen in sugar has been quite huge. The prices have gained 7% on week, 27% in last 1 month, and we are up by nearly 40% in last 12 months for the raw sugar prices. It has been a big jump for the white sugar as well, which also is trading at a 10-year highs. The run-up has come in on the back of weak Indian production that we are talking about, and now the support also comes in after there are source-based information coming in that India may ban sugar exports of not lifted quantity. So 6.1 million ton we understand has been contracted, but there are various reports from officials talking about it, and Bloomberg actually has done a story on this as well, where it says that the unlifted sugar quantities from mills or the sugar that is on transit has not reached the port yet, all of that sugar may not be allowed to export it, which will be very small at around 1 to 2 lakh tons. But the point is, this more than being a quantity is going to be a sentiment impact, and that's exactly what we have seen in the international sugar prices, which I said have increased by 7% on the week here. If you look at the Indian production itself, the last year number was 35.7 million tons. This time, after various downgrade revisions, we are looking at 32.4 million tons, so much lower than the earlier estimates and much lower than last year as well, and that has been supportive. And not just India, we are looking at lower sugar crop this time around in Thailand, in China and Pakistan as well, and even as Brazil has better sugar this time around, but much of that allocation is going in for ethanol, and that is expected to keep the sugar prices on the higher side for longer.
Right, Manisha, thanks a lot for getting us all of that action on the sugar price move at over 10-year highs for the prices there. And actually, all of these stocks of the sugar companies that we were talking about, including Balrampur, Chini, Dwarikesh, all of these are between 15 to 20% for the month. That is the kind of up move that we've seen here. But with that, we are going to get into a break on the show. When we come back, we're going to discuss market technicals. Mitesh Thakkar will be with us. Welcome back. You're still tuned into Trading Hour. The Nifty Bank continues to slip. So you have Axis Bank, which is at the low point of the day now almost 3% in the red. You also have ICICI Bank, which is seeing some weakness right now. So that's, adding to the kind of pain that we've seen on the Nifty Bank. But what's holding up very well is the mid-cap index. It has moved up even more right now. So it's currently almost 0.7% in the green for the mid-cap index, while the market is quite flat. But let's now talk about some stocks which are really moving around. And a CNBC-TV18 news break is confirmed. Godrej Consumer has inked a deal to acquire Raymond's FMCG business. So Surabhi is standing by with all of the details on this one.
That's right. So CNBC-TV18 Newsbreak is now confirmed that Godrej Consumer is going to buy Raymond's FMCG business in an all-cash deal for 2825 crores. Now, this business is being sold to GCPL along with trademarks of Park Avenue, KS and Kama Sutra. Nuvama says that 80% of Raymond's FMCG business comes from deodorants and 20% comes from sexual wellness, with gross margins of 50% and EBITDA margins of 6%. Raymond's consumer business has done 411 crores of revenue in FY21 and scaled it up to 622 crores of revenue in FY23. Now, the view on the street is that this acquisition is slightly expensive at 4.4 times sales and 73 times EBITDA. Just to give perspective, Emami is currently trading at 5 times EV by sales. Now, the deodorant space has historically been very competitive, and that's visible in Raymond's weaker EBITDA margins as well, so that's an added concern. We'll have to watch out for how Godrej Consumer's distribution can scale up the business and deliver growth in an under-penetrated segment of deodorants and sexual wellness.
Okay, thank you very much for joining in. Moving on, shares of PI Industries have also surged in trade, up 9% now after its subsidiary has acquired 2 pharmaceutical companies of US-based Therachem Research. Ekta is joining in with the details. Ekta.
Thanks for that. Well, yes, finally, PI Industries has made a successful foray into the pharmaceutical industry. Remember that they had acquired InSwift Labs earlier, but it had fallen through in terms of a transaction. Now, they will be making 2 acquisitions. This will be funded via cash and their QIP proceeds. They will be acquiring Thermachem Research Medilab for around $50 million. There is an additional $25 million in terms of performance-linked payouts over the next 6 years. This particular company provides preclinical and clinical stage services. The consolidated revenue is $33 million for FY 2022, normalized EBITDA $14 million. They have also acquired an Italy-based company, Archimica, for 34.2 million euros. It's a small molecule API manufacturer as well as a CDMO play. Revenue of around $45 million, EBITDA of around $7 million as of CY22. According to the company, it is going to be earnings accretive from day one, and the company is aiming to build a differentiated CDMO offering across the pharma value chain. Now, a lot of the brokerages that have written on this particular deal are quite bullish on it. For example, Nuvama has said that the two acquisitions shall drive synergies as well as address growth concerns. They've upgraded their call to buy from hold with a target price of 4090. They say that the combined sales and the price that they've paid is a lucrative deal. The implied EV to EBITDA is at around 4.2 times. Investec has a buy target price of 3800. According to them, the two acquisitions should contribute 10 to 12% in terms of revenue and EBITDA. And lastly, Axis Cap says the valuations look reasonable prima facie, and the management expects them to be earnings accretive immediately as well.
All right, Ekta, thanks a lot for that. PI Industries up almost 10%. The other company that we are looking at right now is Shriram Finance. Shares are under pressure, down almost 6% on the back of its fourth quarter numbers. So Abhishek is here with the highlights. Abhishek, pretty muted said this time.
Well, yes, operationally a bit on the softer side when you take a look at the P&L. Business momentum has remained healthy. Disbursements are up 6% quarter-on-quarter. Q4 seasonally is a strong quarter for all the NBFCs and banks. AUM growth was about 16% YOY and about 4.5% sequentially. Asset quality has improved. Gross NP ratio is down about 8 basis points on a sequential basis. However, the NII growth is a bit on the lagging side when you compare the AUM growth. So NII growth is just 0.4% on a sequential basis. The OPEX, that's up 21.2% quarter-on-quarter. This was due to the fact that they took an amortization expense of 300 crore in this quarter at one go, while they could have amortized the same. So going ahead, they will amortize this expense and it will be about 75 crore per quarter due to the amalgamation or the merger of Shriram Transport as well as Shriram City Union Finance. Provisions, that was up about 29.2% sequentially. They did hire one of the auditors to audit their book and find any issues with respect to NPAs or asset quality, due to which they had to make a one-off expense in terms of 295 crore of provisions that they did this time around. Net interest margin, that remains stable at 8.55% versus 8.52%. However, the PAT declined by more than 26% on a sequential basis, which impacted the return ratios as well. Back to you.
Thank you very much for that. The Nifty Bank is struggling, down more than 100 points today, and it's Axis Bank, top Nifty loser now, approaching a 3% cut, and it's broken the 50 and 100-day moving average, giving it company on the way down. ICICI Bank down 0.6%, HDFC Bank down 0.3%, Kotak Mahindra Bank too in the red ahead of numbers tomorrow. But outside of the private sector banks, PSU banks are doing pretty well. The Nifty PSU Banking Index is up 1.3%, and many of these mid-cap banks, South Indian Bank, UCO Bank, Central Bank, IOB, all holding up with pretty smart gains, 3 to 4% up on these mid-cap banks. But let's find out what some index and stock-specific trades are. Mitesh is back with us. Mitesh, what do you have for us?
My sense is that, the overall index, I think, is closer to about 18,000, 1790, 18,000 band, and then we are looking at a test of around 18,150, 170 levels. So closer to about 18,000, maybe, you would want to take some profits off the table and trail your stop to the day's low, which is about 17,885. These are spot levels. And otherwise, trade with long buys. There is no worry in that. The good thing is that the breadth is also picking up, suggesting broader participation. So that's a positive sign. I have a buy on IDFC Limited. I think that's a stock which is given a good breakout today, fresh breakout, making a new swing high. That's a buy with a stop at about levels of 85.5 and the targets of around 92 on the upside can be looked at. And amongst the FMCG names, the Britannia is a good stock to look at. I think that's breaking out again. So that's a fresh buy with a stop at 44.40 for targets of 45.60.
All right, Mitesh, thanks a lot for getting us that quick check on the market. We are going to slip into a break now, but when we come back, we are going to bring you a chat with the management of LTIMindtree to discuss the company's fourth quarter numbers. Stay with us.
Welcome back. Let's talk about the technology space. Now, LTIMindtree's top-line growth at 0.7% was lower than what the street was anticipating. That said, the company has guided for a double-digit revenue growth next year. Margins, too, have been maintained, and that was a positive. The stock is currently up 1.8%. I had a chat with Nachiket Deshpande, whole-time director and COO at LTIMindtree earlier today, and I began by asking him where the pressure points were in the quarter gone by, because the company had guided for Q4 revenues to be better than Q3, but that didn't transpire. In fact, on account of macro weakness, Q4 growth at 0.7% was lower than Q3 growth of 1.9%. So listen in to what he had to say.
If you look at from our Q4 performance, I think apart from the macroeconomic factors, we also talked about the furlough that came back in Q4 was not to the same level that we thought. And there were some delayed starts as the furlough was coming back from some of the accounts that we've had. And that kind of surprised us a bit on Q4 performance as well.
So furloughs being higher than anticipated, and two, a slower start to ramping up certain deals. These were the two factors.
That's correct. That's
okay. But the pressure has particularly been felt on high-tech and retail, because BFSI has done pretty well for you. And BFSI was actually where the macro problems were. Could you tell us sectorally what should we expect going ahead?
See, if you look at our performance on a year-on-year basis, high-tech also done very well. It has grown 14% year-on-year. And that's really, quarterly there could be some ups and downs that happen with specific customers. So we wouldn't look at that as any area of concern. And as we go into FY24 also, we feel fairly confident on the sector. We've the new deal that we just announced in Q4 also was in the same segment. So we believe that for FY24 also, it is showing good traction from a growth perspective.
So your FY24 guidance is of double-digit revenue growth, right?
Yeah.
And this will be evenly spread, or do you think Q1 could still be subdued because you are seeing some furloughs perhaps and the banking issue?
So I think that we talked about in our earnings call also. We will have some softness in the Q1. But the reason also, I think, as we talked about, is that the deal types have changed as compared to previous years. We see a lot more deals which are cost takeout, efficiency plus transformation kind of combination deals. And many of these deals hence have vendor consolidation and transition phases in it, and which means that it takes 2 or 3 months before the revenue starts to ramp up after we start executing those deals. That is why we think that Q1 will still be a little bit moderate, but based on the deal activity and the deals that we have already closed, we are confident of double digit in the overall financial year.
When you say softness in Q1, are we looking at flat growth or perhaps even a possibility of degrowth? Or will growth be similar to Q4?
Yeah, we're not looking at degrowth in Q1.
So what could Q1 growth look like? Similar to Q4 or flat?
We don't give guidance for specific quarter, but it is likely to have the same softness, but we definitely won't have a degrowth.
And furloughs, the issue about furloughs, that's behind us now?
That's behind us.
So no more furloughs in at least the high-tech vertical?
At least, yeah, not that we are aware of so far.
Okay. Margins, you managed to defend margins, but they're still lower than the 17.5% margins that you had seen in the prior quarters. When do you think you can achieve those margins, and what's the outlook on margins for FY24?
So I think we talked about it in the last earning call itself, that we believe by FY24, we should be able to come back to the margin performance that both the companies were delivering prior to merger. And we still remain confident that in FY24, we should be able to return to that margin levels.
So that would be closer to 17.5%?
I think between 17 to 18 is what we used to perform, and we believe that we'll be confident to be in that range.
So FY24 margins seen between 17 to 18%. There was also some, news report which suggests that the company has delayed the onboarding of freshers. They have introduced a 6 to 7 month long training program. Freshers who refuse to attend the program will have their offers revoked. Can you tell us what's happening on the fresher hiring front and the kind of salaries that you've offered to them? Yeah.
Sure. So there is a program called Ignite, and that we had launched it in 2019 itself. And that program, the focus of that program is that when we hire freshers, we onboard them through the year, right? Based on the business need. They don't all join in one go, but join distributed. And hence there is a gap between they graduate and when they join us. And we wanted to provide opportunity during that period for those freshers to continue their learning path. So we offered all of our hybrid and online learning resources to the freshers so that they are able to equip themselves and are better skilled when they actually join us, so that they can be they will be able to contribute directly in the customer engagements as they get deployed. And that program has been running very successfully for last 2 years plus. This was a erstwhile LTI program. So as a part of our integration efforts, when we looked at best practices from both the organization, we looked at this to be a best practice that we would like to continue in the combined org. And hence you saw that that was also extended to the Mindtree freshers, which was still not onboarded. If you look at from a onboarding perspective, we had paused our onboarding and also reduced our lateral hiring during Q3 and Q4 quarters as we were going through the merger. Because as our systems were coming together, as our organization structures were coming together, we needed to have better visibility of skill base across the combined org. And hence we took a pause before we had a better understanding of that inventory. Now, as we go into FY24, as we have completed the merger, we will be back to our usual way of onboarding freshers. So like, for example, our FY24 onboardings are on track that we had planned. And we will onboard most of the freshers in the first 3 quarters of the year like we had always done in the past.
Just one final question. Will all your verticals grow? BFSI, healthcare, retail, high-tech next year in double digit, or is growth going to be a bit lopsided based on what we've seen? And secondly, did you see any deals getting cancelled? You spoke about delays and ramp-ups, but what about deal cancellation?
We've not seen any deal cancellation or even the project cancellation on our existing portfolio or the deals that we have won or competing. As regards to the vertical-wise or industry segment-wise growth in the next year, I think we expect the growth to be all-round. We don't see one sector significantly outperforming. Now, whether everybody does double-digit or not, I think in a given year, some verticals might grow faster and some might not grow faster. And for us, it is more than industry. It's a function of the portfolio of clients that we have, because each client won't go through the similar spend or growth curve in every year, right? So that's why it's very difficult to say that whether every vertical segment will grow double digit or not, but we don't expect growth to be lopsided. We expect it to be broad-based and across regions and across verticals.
Okay, so the key guidance from LTI Mindtree is that Q1 is going to be soft because the nature of deals is changing. Now more deals are towards cost optimization, and that has a different cycle because these are vendor consolidation deals. So it typically takes a few months before the revenues of these projects start kicking in. So according to the company, Q1 is going to be soft, but it doesn't mean that it's going to degrow. For the full year, FY24, the company is going to see a double-digit revenue growth. On margins in the current quarter were, I think, 16.3%, 16.5% thereabout. The company has said in FY24, margins will go back to 17 to 18%. These were the margins the company used to enjoy prior to the merger. So margins will revert back to 17 to 18%. So these are the key guidance points from the management of LTI Mindtree. Now let's talk about Wipro. Now Wipro's Q4 was disappointing. Their guidance was disappointing. The company is guiding for a revenue decline of either 3% or at best a decline of 1%. Yet the stock is higher in trade. It's up close to about 3%. In fact, for the longest time, it was a top Nifty gainer, but now it's been surpassed by Adani Enterprises. So Wipro is now the second biggest mover in terms of the index. It's getting supported by the buyback news of 12,000 crore rupees. We had a chat with the management of Wipro and we asked him what was the reason for this dismal Q1 guidance. Where is it that they are seeing headwinds, and also the outlook on margins? Because the company's aspiration is that margins will hit 17%. Are they on track to achieve those margins from current levels of 16.3%, or is this something which is going to take time? What's the priority between getting growth back on track and margins? Listen in to what the management had to say.
In some sectors, in some industries, certainly banking, financial services, also the technology sector, where what we're observing is that there is a certain reduction, slowdown of the discretionary spend, and that is definitely generating a little more of uncertainty on our top line for Q1. Not one single project or got cancelled, not a single project. There's I would say there is not one event that would have any material importance to the guidance for Q1.
As I look at next couple of quarters, as you can imagine, our priority is really revenues and how do we convert the deal wins into revenues, how we get to a strong growth trajectory, steady state growth trajectory back, and hence our commentary is that we will try and maintain margins around the range that we have delivered in recent quarters.
All right, we'll try to maintain margins at current levels. That is the word coming in from the Wipro management. But with that, we are going to get into a short break. When we come back, we're going to discuss the market. We'll have Sampath Reddy, CIO of Bajaj Allianz Life, with us. Stay tuned. Hey guys, welcome back. You're still tuning into Trading Hour, and let's get you a conversation going on the markets now. We have Sampath Reddy with us, CIO of Bajaj Allianz Life, to discuss the way forward to the market, some sectors that he likes as well. Mr. Reddy, thanks a lot for joining us. This is Pavitra. I don't know if you were able to listen into the last conversation. We were talking about a lot of the tech earnings that have come through. How do you look at this space now? So far we have seen a few positive surprises from the mid-cap tech space, but there is definitely pressure in a lot of the larger names. How do you look at this entire space, and do you think after valuations correcting a fair bit, it now seems okay for an investment, or would you still stay away completely?
Right. I think the IT services as a sector, as I would say for the Q4, have disappointed in terms of earnings. In fact, the disappointment was there both in terms of top line revenue growth and as well as the margin side. They have been facing the cost pressures at the same time. Demand was also not very encouraging. I think that was a sort of a disappointment for the for the overall quarter as such. But even though, in spite of the IT sector disappointment, I would say the Q4 earnings are still likely to be pretty much in line with the expectations in terms of aggregate earnings growth wise. But IT sector has disappointed. I think overall, if you see there are headwinds in terms of demand growth wise, especially with the interest rates moving up substantially in the US market. There seems to be a pressure on the demand side, and also BFSI is one of the biggest sector for the IT spend in terms of IT spends wise. That sector is also seeing quite a bit of headwinds, especially if you see several of the smaller banks are actually going through quite a bit of, I would say, the distress in terms of the more so driven by the ALM side of mismatches. Because of all of these reasons, I think overall the growth, IT spending growth is a little bit of expectation wise got downgraded, but the stocks have already corrected substantially. I think in spite of these headwinds in the US geography, IT sector is still likely to deliver about 8 to 10% earnings growth FY24. This is slightly below the Nifty earnings growth estimates of about 12%. But I think given the stocks have corrected, maybe I think they are giving a slight opportunity to buy into the market, buy into the stock sector.
You don't expect any PE derating in the IT companies, at least in FY24, because the earnings growth rates have fallen off? Or do you think the worst of the PE derating is behind now?
I think, there has already been some amount of, PE derating has already happened. And if you see the overall earnings, deceleration, it's about 2 to 3 percentage point from earlier expectation of about, 12%. Now earnings are cut to about 10%. I think at this level, given that overall earnings growth for the Nifty itself is around 12% for the next financial year, the IT sector is still going to deliver a decent earnings number in terms of growth wise. So may not see a significant derating from here on, I would think so.
Okay. There are some pockets within this market that are really doing well, right? Even when on an index level, it looks quite flat, such as the railway-related stocks, some of the defense names as well. Are these pockets that you would be interested in looking at, names like RVNL, Ircon, Railtel? Are these names that have your attention?
Right. I think overall capital goods sector as such has been doing quite well, and partly driven by the government spending, especially on the defense side of the spending. And also you are seeing a good amount of capital spending by the railway sector and also the urban infrastructure. And not only this government-related spending, but also the PLI measures which we have taken in the last 2 years, that is also leading to the good amount of capital spending. All of that is actually leading to the good order inflows for the capital goods sector, and earnings growth is also coming good for the capital goods sector. I think the sector overall we like that, and especially in that in the capital goods sector we like more of most of these multinational subsidiaries which have got listed here. We've been liking those kind of companies, and we continue to own such a large number of those names.
I know you won't talk on individual and specific stocks, but how should someone approach the fall that we've seen or the performance of a company like, say, Laurus Laboratories? Q4 has been weak, but the stock has already corrected 50% in the last 1 year. And the company's guidance is that things will eventually improve once this period of consolidation comes to an end. So what's the general approach in these pharmaceutical names when we do see a big earnings miss, if it happens for more companies? What's the thought process?
Right. Yeah, I will not really go into the details of the Laurus numbers, but if you see overall as a pharmaceutical sector as such, they've been facing some sort of headwinds in the US geography, especially in terms of the pricing side of the pressure. I think a large part of that is now behind. We are, in terms of exports wise, domestic pharma continues to do well, but from export side of the story, it's just beginning to bottoming out, I would think. So overall, the US generic export oriented companies, beginning to show a good recovery. I think that's a sector we look as a turnaround bet in the overall market.
Okay, that point is well taken. Another space I want to ask you about is this entire real estate index, right? We've seen quite a move higher on a lot of those names, but it's very divided because you have the luxury space doing really well, perhaps, while the affordable segment is not quite there yet. Is this a good investment opportunity in your opinion?
Real estate, as an asset class.
About the stocks.
Yeah, as an asset class, in generally, given a good returns for the investors over a long period of time, but that I would think is more as a, the physical asset. The experience, at least, I would think in the stock market side of the listed companies as such, not sure, they've generated a big amount of wealth for the investors. So we're not really, on top of the sector, and I don't think we have any of the exposure to the real estate sector in this juncture. But of late we've been tracking the sector, but we understand that the urban side of the consumption still continues to be good, and especially more so on the luxury segment. That companies exposed to the top end of the luxury market, I think they're continuing to show good performance.
Okay, that's some view coming through on the markets and the way forward. Thank you very much, Mr. Reddy, for joining in. Numbers coming in from Car Trade Tech. The company has reported a profit of 15 crore this time, which compares with a loss of 25 crores in the March quarter. But subsequently, the company has been reporting, profits. So in the March quarter of last year, the there was a loss of 25 crores as our team was putting out. But in the June quarter, there was a profit of about 3 crore, which went up to 6 crores and went up to another 14 crore in the December quarter. And now this is further improved to about 15 crores. So the company is focusing on profitability, and the street right now is at least rewarding the numbers. The top line has come in at 96 crore, unchanged compared to the prior quarter, and just up 3.5% on a year-on-year basis. Get into a break. On the other side, we'll come back and talk about Kotak Mahindra Bank. That's the big one due to report numbers tomorrow. Welcome back. Let's get to the big earnings for tomorrow now. Kotak Mahindra Bank is due to report Q4 numbers. Abhishek is here with the fine print. Abhishek.
Well, for Kotak Mahindra Bank, the key thing to watch will be the deposit growth. Remember that in the previous quarter, the CD ratio was north of 90% plus, and how deposit moves and at what cost will come, that needs to be seen closely. Loan growth as per Phillip Capital is expected at 20% YOY and about 4.7% sequentially. The net interest margin can decline by 10 basis points on a sequential basis. However, it remains robust at 5.37%, which is the expectation of Phillip Capital. You need to watch out for the low-cost deposit momentum. We have seen CASA deposit, or at least saving depositors moving towards a term deposit. So how that will move, we need to watch that closely. Asset quality expected to improve. Phillip Capital is expecting gross NPA ratio to come down by 7 basis points. They are also expecting slippage of about 800 crore for the quarter versus 748 crore in the previous quarter. Management commentary and outlook will be important. We are working with a poll of NII growth of about 28.7% YOY and about 3% sequentially, while profit as per our poll is expected to grow by 7.5% YOY and about 6.5% sequentially. Back to you.
All right, Abhishek, thanks a lot for that. We trust you to work through Saturday and tell us how the numbers look from Kotak Mahindra Bank. We're going to wind down on the show with the market around 40 points in the green. Thanks a lot for tuning in. We have halftime report after this break.